systems. AI startup Perplexity offers to buy Google's Chrome web browser, makes an unsolicited bid of more than $34 billion, according to the Wall Street Journal. Google may have to sell Chrome as a part of antitrust proceedings. Well, those are the headlines we've been tracking for you this evening. Let's start with the top story. AI startup Perplexity made an unsolicited offer to acquire Google's Chrome's browser for $34.5 billion, as per Wall Street Journal. Now, this figure is higher than Perplexity's current valuation of $18 billion. The company has several investors, including large venture capital funds, that have agreed to back the transaction in full. CNBC's Dan Murphy is here with more.
AI startup Perplexity has made a long-shot offer to buy Google's Chrome browser for $34.5 billion. Venture investors have proposed funding the deal, according to the company. It comes after the Department of Justice suggested Google divest Chrome, its flagship search browser, as part of an antitrust suit the company lost last year. That ruling said Google had illegally monopolized the search market. The unsolicited bid by Perplexity is higher than the AI startup's current valuation, which is estimated to be around $18 billion. Perplexity has seen rapid growth, climbing from a $500 million valuation at the start of 2024 to where it is now, after at least 5 capital raises. CNBC understands there's no current Gulf sovereign wealth investments in Perplexity. It was reported by PitchBook that Qatar's QAA was a backer, but we have not been able to independently confirm that investment yet. In April 2025, Perplexity's CEO said the search engine was serving approximately 30 million users. It has received backing from investors including NVIDIA, SoftBank's Vision Fund 2, VC firms New Enterprise Associates and IVP, as well as Amazon founder Jeff Bezos and Meta's Jan LeCun. Perplexity is best known for its AI search engine, a potential Google challenger that gives users simple answers to questions and, unlike many other AI search engines, links out the original source material. Last month, it launched its own AI-powered browser called Comet.
Well, India's home services space is getting a 10-minute makeover, and no, it's not food or groceries this time. Pronto, which is the real-time household help app, has just raised $11 million in a Series A funding round, and over the next 12 to 18 months, it will expand beyond Gurgaon into Mumbai, Bengaluru and other metros to set up micro-hubs across key residential clusters to guarantee sub-10-minute fulfillment at scale. And joining us today is founder and CEO Anjali Saldana to unpack the business model of the company. Anjali, thank you very much for your time here on CNBC-TV18. For decades, finding domestic help in India has very much been about having your informal networks and also luck. Now, Pronto is promising to, provide trained help in 10 minutes. What does it take, both operationally and financially, to compress a system that was once so uncertain into something dependable?
Yes. So I think the key thing is the main way people have approached formalizing and building a business around the sector has been to be an Uber-style matching platform. And we realized very quickly that that isn't sufficient here, right? That's not, you require much more operational control over your labor supply chain end to end. And so that means, in-house doing the recruiting, onboarding, training, performance management, all of that is done in-house and requires a huge amount of effort from the team and really rigor in making sure that every step of that process, we maintain a super high standards.
Well, you've just raised this $11 million to build what you call is going to be a new layer of urban infrastructure. Break that down for us. How do you plan to deploy this capital, and where will investors expect returns? Expansion, tech, or team?
Yeah, so this is largely going to be used for geo expansion into cities, including Bombay and Bangalore. We currently operate only in Gurgaon, and so this will be primarily used for opening up across the country. And with that requires expansion of the team, right? We have field operators in every hub that we set up. We have a central control tower team. All of that has to expand as we expand geographically.
This plan to make household help really a high-frequency service for users, just like groceries or cabs. Is Pronto sticky enough, you think, to be a daily line item for urban families in India?
Yes, a huge number of our customers are using us every single day. And so we already see a very high repeat frequency among our customer base, and really people treating this as, a utility. I mean, in the end, this is a necessity on a day-to-day for most urban households, and it's not a once a week or once a month use case. It's an everyday use case. And so we've already seen that demand pattern emerge.
Well, guaranteeing the sub 10-minute fulfillment while also offering workers some predictable shifts, it's quite the promise, but it also sounds very expensive. Is there a market or a need you see for 10-minute fulfillment for house help? And how quickly do you plan to scale the service?
I mean, it is absolutely, there's absolutely demand for 10 minutes. As we've seen, the higher frequency with which you're able to hit the 10-minute SLA actually has a flywheel effect where more people are booking that. Because if you're actually able to hit it, then customers build trust in your ability to be there in 10 minutes and rely on that rather than having to schedule ahead the booking. And so we've seen a huge amount of demand for that 10 minutes or less. And it's been ever increasing. And in terms of, expansion, we have built sort of the modularized version of Pronto in which we can deploy it into new geographies. And so we've been able to, in the last few weeks, expand very quickly into new areas of Gurgaon. Like we've, in the last 1 month, almost doubled our service area without too much strain on operations. And so, we figured out how to essentially how to deploy the playbook into more and more micro markets.
Anjali, you're talking about micro hubs, last mile operations, shift logistics. All of this sounds a lot like hyperlocal delivery businesses. How similar is the cost structure, and what is different in terms of margins and workforce management as well?
Yeah, I mean, the cost structure is very different. So let's talk about CapEx first. So if you're opening a dark store, investment is required because there's infrastructure within the store, there's and there's working capital required for inventory. And so that is not a factor in our business, right? Our hubs are simply just like rooms that are air conditioned, and there isn't a huge amount of shelving or any infrastructure needed there. And so the CapEx required to open a hub is significantly lower, and that means that less investment or less capital is required for expansion than say for your quick commerce businesses.
You're a very new business, of course, but what is the roadmap for profitability in that case?
Certainly not profitable today. Obviously, as we expand, there's a large amount of investment that's required. And especially as we're expanding to new geographies, in the run up to that, you have to build up your supply pool in order to deploy that into new areas. And that obviously takes money in order to do that, as well as building the brand and marketing for the first time and getting Pronto's name out there. That all requires marketing spend, as well as the HQ team, right? And if you think about your HQ, that's where you get operating leverage from as you scale. Right? Your percent of revenue that you take for your engineering team is obviously going to be very high, over 100% now. Or actually isn't over 100%, but in general, your HQ team is where you'll see a lot of operating leverage going forward, and that impacts your EBITDA margin today. So very EBITDA negative today. But over time, we think, I don't see us, getting to profitability in the next 2 years, but within 5 years, ideally, we'll be EBITDA positive.
Well, finally, let me ask you, what really keeps a competitor from copying this tomorrow? Because this is a space where we're hearing of players like Urban Company come up with something similar. And of course, there is this huge informal market that already exists. So how will Pronto protect itself?
Yeah, I mean, there's a couple things here. One is that, we have laser focus on this business, and we built our business model from first principles. And with that, I describe Pronto's operations as a 1,000-piece machine, and we understand, of those 1,000 pieces, what are the 50 most important, and of the 50, what's the 5, and of the 5, what's the single most important piece, and that is allowing us to execute better. And I think in general, what keeps this business moated is just there is a high capital barrier to entering this, right? And so there's going to be a limited set of companies that are going to be able to acquire the capital in order to enter the market. But in addition, long term, what determines the winner is going to just be operational rigor and execution, and just focus on this.
Well, Anjali, that's quite the interesting service you're building, and it's been a pleasure speaking with you. Thank you so much for your time here today on Startup Street.
Well, moving on to our Investor Eye segment, early growth investment fund Atomic Capital has announced the final close of its maiden fund at 400 crore rupees, targeting early growth stage consumer startups in India. Now, the Mumbai-based fund will invest in sectors including food and beverages, personal care, apparel and consumer technology, with check sizes ranging from 10 to 30 crore rupees. The fund claims it takes an active operational role with its portfolio companies and aims to back 10 to 12 startups over an 8-year horizon. To talk about the fund strategy and the future of Indian consumer brands, joining me now is Apurv Gautam, founder and managing partner of Atomic Capital. Apurv, welcome to Startup Street. Now, you position Atomic Capital as an operating VC. First, what does that mean in practice? And then tell us, how does your hands-on approach differ from traditional venture capital?
First of all, thank you for having me, and it's a pleasure to be here. I think our core belief at Atomic Capital is that throwing money at the problem doesn't solve the problem. And it's not just capital which is required for a business to be successful. So what we like to do is we like to come in at a stage which we call it post-product market fit. And we apply a very unique hands-on approach where we obviously provide capital, which is necessary but not sufficient. But beyond that, we help founders in X to 10X journey. And in that journey, we actually contextualize our playbook for each company because we believe that every company is unique. Having said that, there are common principles. For example, building the right team, making the right strategic choices, having the right decisions. I think that is where we help founders in that journey.
All right. Apurv, with check sizes of 10 to 30 crore rupees and a portion of the fund preserved for follow-on rounds, you're building a focused portfolio of 10 to 12 startups. Now, within consumer tech, what innovations are you most excited to back right now?
No, I think that's a very important question for us because given our playbook requires us to spend significant time with our portfolio, we are not going to do a spray and pray approach where we make large number of investments. That's why we like to take large concentrated positions in fewer companies. Having said that, I think the few innovations which we are really looking forward is we are chasing India's consumption in 2030. And if you look at India's consumer in 2030, what will drive that consumption? And I think a couple of themes emerge. One is Middle India. We're extremely bullish the way Middle India is going to drive the future of India's consumption. And second, the digital infrastructure. I think the way India's digital infrastructure is evolving, led by UPI, I think very bullish on how can we leverage that in our investments going forward.
In fact, you've already invested 50 crore rupees in 4 startups like, Conscious Chemist and Doodh Wale Farms. What attracted you to these companies? And if you could also take us through the cornerstone of your investment philosophy, how do you evaluate a startup?
Absolutely. We call investing is a professional marriage. And then the way in marriage, what matters most is 2 people. Similarly, I think in our journey, the founders play a very, very important role. Given that we spend significant time with our founders, and our playbook is very, very extensive, and we sort of spend significant time with them. So I think founders and our alignment with the playbook plays a very important role. Second, I would say we focus a lot on capital efficiency. And our view is that capital efficiency is DNA of the company. And a lot of founders feel that profitability should be solved only at scale, while our view at Atomic Capital is that you need to solve that from day one. So we also like to back companies which are solving the problem in a very capital efficient manner. And last but not the least is revenue momentum, because we are in the business of making good businesses great. So that's, I think, the last thing we look for.
All right. And in fact, you're currently evaluating over 20 companies and have issued a term sheet for your 5th investment. How many investments do you plan to make by year end, Apurv?
Absolutely. I think in our view, it takes significant time and effort from our side to deploy our playbook, because we are not just writing a check and moving on. Because we are spending significant time and energy with each and every portfolio company. For example, we connect with every company once a week. Because of that, we are not going to make large number of investments. Thankfully, we are getting a lot of founder love, and we are getting inbound from multiple companies and founders. We want to be very razor focused, and we will do approximately 1 investment per quarter. So this year, I think we'll do mostly 2 to 3 more investments.
All right, 2 to 3 more investments this year. Let's get a sectoral view. The consumer sector is rapidly evolving with shifts in preferences and technology, emerging trends in Indian consumer tech. If you could tell us, what are you most bullish about? You spoke about UPI and Middle India, but what are the emerging trends that you're most bullish about?
Absolutely. I think if I look at India's consumer in 2030, and if India GDP per capita will double, hopefully by then. If I take that view, I think there are a few mega trends which are emerging. One, as people become more affluent, they want to look good. So there are certain categories which will fall into that bucket, whether it's fashion, whether it's skincare, whether it's cosmetics, hair care. So I think that's one big piece of our investment. Second, I would say as Indians become more affluent, they want to focus a lot more on wellness, whether it's physical wellness, mental wellness, spiritual wellness. So I think there are a lot of investment. I think we would like to make an investment in that category. Third, I would say that consumer enabler, because the way consumer space will be evolving, a lot of consumer brands will be coming up. The companies which are solving a pain point of a consumer company, whether it's a
Sure.
logistics company, a payment company, or manufacturing company. So consumer enabler will be the third piece we are very excited about.
All right. Many startups, Apur, face challenges scaling beyond initial product market fit. And you spoke about how Atomic Capital supports founders operationally beyond just funding. So what would be your one piece of advice for early growth stage founders?
It's absolutely right. And we have seen that as well. And I think for me, the core reason is that people feel that throwing money at the problem will solve the problem. And capital alone will be able to help them solve all the problems. But in our view, that is not the case. And if I were to offer one piece of advice, which I've seen a lot of founders realize but don't do that well, is building the right team. What I've seen is that what it takes companies to go from 0 to 1 is not necessarily true for 1 to 100. And founders are very reactive and they like to hustle. But org building and hiring is not something you can do in a reactive manner. So our ability to work with founders in a very proactive manner and help them build organization, I think makes a big difference. And that is something I would advise everyone.
Okay. My one final, question, what is your roadmap for the next 2 to 3 years in terms of fund deployment and building long-term value? And will you be announcing your second fund anytime soon?
I think making promises is easy, delivering them is hard. So I think the promises are made to our investors, so that part is done. Right now, it's time for us to just put our head down and execute. Right now, the entire team's focus is on to deliver Fund 1, and we are not just thinking about anything else. And hopefully next time when I'm on your show, I can talk about Fund 2.
Absolutely. We'll surely keep a track of that. Apurva, many thanks for joining us on Startup Street today and wish you the very best with your Fund 1.
Thank you for having me.
On that note, it's time for us to head into a short break. But coming up, CEF Group bags 38 million euros in a mix of equity and debt. How does the startup plan to spend the funds? We put the founder on the hot seat to find out more. Stay tuned. Welcome back to Startup Street. Clean tech player CEF Group has secured €38 million in equity and debt from the German Export Finance Bank to set up 2 state-of-the-art compressed biogas plants. Now, the first step in an ambitious plan to build 22 such facilities across the country under the government's SATAT scheme. These plants will convert municipal and agricultural waste into clean fuel process, thousands of tons of organic matter daily, and produce valuable byproducts like organic manure and refuse-derived fuel. With projects in Jammu, Ahmedabad and Western UP already in advanced stages, CEF says that this investment will fast-track India's transition to a circular economy while creating new revenue streams for rural communities. Joining me now to discuss this further is Maninder Singh Nayyar, founder and CEO of CEF Group. Many thanks for joining us on Startup Street. First up, if you could elaborate on the €38 million equity and debt funding package from the German Export Finance Bank and how it will be deployed for the first 2 CBG plants.
Yeah, very good evening. So this initial debt funding that we have got from Germany, plus the equity funding that we have from few conglomerates in India, is going to be deputed to 2 projects primarily, one for the city of Jammu and one for Ahmedabad. In Jammu, we are going to treat 350 tons of municipal solid waste every day. And in Ahmedabad, we're going to treat 500 tons of municipal solid waste every day. In totality, we're going to make around 27 tons of compressed biogas and almost 80 to 90 tons of organic manure and almost 150 tons of RDF on everyday basis to convert the waste into wealth and biofuels to make it into a circular economy.
All right. So tell us, beyond the initial projects that are ongoing in Jammu and Ahmedabad, what is the timeline and the geographical plan for setting up the 22 compressed biogas plants across India?
So it generally takes around 1.5 to 2 years to set up a plant of this magnitude.
Yes.
And in Jammu and Ahmedabad both, we are going to commission the plants next year, since the work was already going on in this plant since last 1 year. And following these plants, as now we are nearing completion and commissioning, we have already started launching with other municipal corporations where we are signing more such deals and going to set up more such plants across the country.
So tell us, Maninder, what kinds of agricultural, agro-industrial and municipal waste streams will the CEF Group tap into for these plants, and how will they ensure consistent supply?
So we are primarily focusing on the municipal solid waste, where we generally take a 25-year supply contract from the city's municipal corporations. Apart from that, we target the sugar mills, which are large-size sugar mills, and that have the commodity called pressed mud, which is generally a waste for them. We take that for a period of 20 years, and we convert that into biofuel as well. So these are the 2 primary sources of raw material that we first engage with on a long-term basis, and then we start building the plant and complete it thereon.
So also, Maninder, throw some light on how do these projects directly support the government's SATAT scheme and what policy incentives or partnerships are enabling this growth? If you could throw some light on that.
Yeah, sure. So SATAT scheme is basically a scheme that gives leverage to any such manufacturing unit to produce bio-CNG or CBG as it is called, and sell it to the oil and gas majors like Indian Oil, GAIL, Hindustan Petroleum and all. So we get a fixed price, what government has given a minimum assured guarantee. So that makes the project very bankable and doable. And not only that, once we set up these projects, there are multiple benefits that comes along. Number one is that we don't need the imported CNG that we import from other countries. So it's a import substitution. Second, we are getting energy reliant. Third, we are generating jobs, and that too in large extent, because these 2 plants itself are generating over 300 jobs.
Yes.
And we make bio manure, organic manure as a byproduct, which then replaces the chemical fertilizers. And that is also a big saving, not only in cost, but also in health and soil health to our nation. So all these things come together, along with, of course, the environmental impact and environment protection that we get along with the various other benefits I just told you.
Okay. So, Maninder, with the new plants processing up to 850 tons of MSW per day, what is the projected CBG output and how will it be integrated into India's fuel supply chain?
So the CBG output in Jammu is going to be 9.8 tons per day, and
Okay.
in Ahmedabad is going to be 17 tons per day. With this total of approximately 27 tons per day, this gas is going to be directly injected into the GAIL pipeline. The agreements are already signed. The locations are already identified. The pipeline work has to be done jointly between GAIL and us. And that is how the gas will reach the markets. And further, it will be used as a vehicle fuel that we use in every day in the cars to run the cars on CNG rather than running them on diesel or petrol.
So, besides CBG, Maninder, what byproducts like organic manure and RDF will be produced and what markets or sectors are they intended for?
So the biomanure or the organic manure which is produced in these plants is for commercial farming. And we already have another wing in our company where we specialize in manufacturing and enrichment of such bioproducts. So we have already established a name in this sector. And apart from that, there's all the inorganic material is called RDF when it comes out. This is generally used as a substitute for coal in the cement plants. So we will be supplying this RDF to the cement plants as a substitute of coal. So it saves coming from coal and it will come from this source.
All right. On that note, I'll have to wrap up our conversation. Maninder, many thanks for joining us on Startup Street today and wish you the very best with all your growth plans that you mentioned today. Thank you.
Thank you so much.